Corey Bayshore and Justin Dunwoody here from Polaris Advisors. Today we're to talk about diversification and asset allocation. When you think about diversification, probably the one thing that most people think about is just not having all your eggs in one basket. When you look at the periodic table of investing, and this is just going back since 2008, the one thing I'll just point out, with this, and many of us remember the periodic table, from our science, classes in high school or maybe even in college. But you'll notice, that the best performers, tend to change from one year to the next. Now, we did have some repeat, performers that did better, 1 year after the other. But over time, you'll notice that, the top performers sometimes the following year are the bottom performers, and kind of vice versa over time. The key thing just to point out, I would say, with this chart is if you look kind of in the middle or look at the gold colored, which is the asset allocation. So again, what asset allocation is basically, or what it's designed to do, is to have components of all of the colors. So we're talking large cap stocks, small cap stocks, international stocks, bonds, you name it. And you'll notice how that kind of runs more middle of the road. So not necessarily going to be the top performer, but probably more importantly for many of you as you're trying to save and accumulate money, for the future, it's not the bottom performer either. So again, takeaway here and point trying to make is not trying to pick or choose the best performer, 1 year over the next, because as you can see, sometimes if you pick the best performer from last year, that may be the worst performer, the following year.
We see that a lot when we meet with participants in 401k plans, that we get it all the time. Hey, this one looked like it did really good. When I look at that 1 year return, well, this is a perfect chart just to look at it and say, well, does it make sense to put all your money in that one that performed best last year? Because when you look at that chart, you can see, just follow a color. If it performed great a couple years in a row, many times you'll see it's down towards the bottom.
Yep.
So we also have another chart that we're going to pop up for you guys too. It just basically goes through a balanced portfolio. It's like a 60-40 type portfolio. So if we're, diversified, maybe middle-aged, we want to have about 60% in stock and about 40% in bonds. And you can actually see on the chart there basically the returns of the stock market compared to the returns of the bond market. And then the average return of a 60-40 type portfolio. So not too far off of a 100% stock portfolio as far as average return, but really kind of mitigated the volatility and had considerably less fluctuation as opposed to 100% stock portfolio.
Yeah, and I would add, a 60-40 portfolio, Justin and I, we have, clients that are in their 20s, and we have some that are in their 80s. That is a more conservative, allocation. So, certainly from a risk, standpoint, kind of more middle of the road risk-wise, but, from a return potential, more middle of the road as well. So everybody, one thing I would say, with asset allocation or with diversification is it should be, somewhat tailored, to your needs, your goals, more
your appetite for risk too.
Yes, absolutely.
Yeah. So that'll kind of lead us then to when you're looking at those portfolios and your level of risk that you're comfortable with. What does that mean in kind of a real world scenario? So we have another chart we're going to pop up about diversification and your average investor. The really kind of a cool chart, but it just shows you this is pretty recent history too. So this is just back to the shutdown in 20 from COVID, but you can see it peaked out February 19th. The S&P did. It troughed on March 23rd. It was down over 30% in just a few weeks, which is very abnormal. Mm-hmm. But you can see, a 40-60 portfolio troughed much higher than a 100% stock portfolio, but it recovered. And by June 8th, it took till June 20th for a 60-40 to recover, and then it took all the way out till August 10th for a 100% stock portfolio or in the S&P 500 to recover. So that's where when you're nearing retirement or in retirement, you don't want those real large declines and a lot of volatility. You can see how that mitigates it, having that kind of mixture and that diversification. Now, long term, as Corey mentioned before, I've worked with a lot of younger folks that they want to make as much as possible long term.
Yep.
The S&P 500 now significantly higher than a balanced portfolio or a 40-60, but that volatility there during the shutdown is for a lot of folks unwanted.
Weren't able to stomach it.
Exactly.
Yeah. And that's why when you look at the bottom half, the chart there, and we look historically, and I can tell you, Justin and I have been doing this, for a long time, combined, over 40 years of experience. And when you look at, the average investor, and in this chart you can see, since 2001, the average investor, having done a little less than 3% per year, compared to the market, stock market S&P 500 at 7.5%. Why such a significant difference? And we can tell you the reason why. People allow, and that example of the over 30% downturn at the height of COVID, people allow their emotions to take over. And if there's one thing through this podcast series that we'll try to get across is, as best you can, to try to remove your emotions from the equation. And everybody's different, so no matter the age, everybody's different. But just bear in mind, if you're in your 20s, you're not going to be utilizing, especially if we're talking about money in a 401k, you're not going to be touching this money till probably in your 60s, or at least in your 60s, or maybe even later, potentially. So bear in mind that you can ride out these ups and downs that the market will bring. And this chart does a great job of at least showing why you want to try to remove your emotions from the equation, and trying to find an asset allocation or diversification that fits you and will enable you to experience the highs in the good years in the market.
I think that kind of wraps up our conversation on diversification.
Thank you.